Hello friends, my name is Mohit Pandey and I'm a student of first year PGB at IIM 3G. As a part of our economics assignment, I'm presenting you this video regarding BASEL norms. So what are BASEL norms basically? Due to the pervasive problems in the banking industry related to the credit risk, operational risk and lately the liquidity risk, the BASEL norms were introduced. Basel is a place in Switzerland where the bigwigs of the industry met, of the banking industry, and they created these norms as a form of risk management. Earlier, they started with risk management, credit risk management, extending it to operational market risk in Basel II norms. And after the 2007 recession, which percolated worldwide, they introduced the liquidity risk as well. So let us study what would be the impact of BASEL III norms on the Indian banking industry. The new norms will definitely address the systemic loopholes in BASEL II as well, because BASEL II did not involve the liquidity risk, but it will have some impact on the banks as well. These are: first, it would be having higher capital requirement. Presently in India, most banks' common equity ratio falls in the range of around 6 to 10%. Hence, in my opinion, banks may be able to comply with the higher capital requirement as per BASEL III norms at least by 2016-17 is my guess. This would be without infusing any fresh equity, even while taking into account the marginal increase in capital requirement. The next will be the pressure on return on equity. To meet the new norms, apart from government support, a significant number of banks have to raise capital from the market. This will push the interest rate up, and in turn, cost of capital will rise while the return on equity will come down. It's like hoarding towards the market to get the cash from shareholders. To compensate the ROE loss, banks may increase their lending rates. However, this will adversely affect the effective demand for loan and thereby their interest income, which is a significant chunk of a bank's income. What are the actions required from the banks? To address these issues and to protect their profitability margins, banks need to look beyond their regulatory compliance and take proactive measures, assessing their line of business, level of risk profiles, economizing capital and drawing up more funding strategies. What would be these funding strategies? The first one could be the changing business mix. There is a lot of risk involved while corporate banking is concerned. Since retail banking has a comparatively lower risk weightage, the impact on higher allocation of capital will be less on retail banking. Further, in corporate banking, as chances of default in short-term loans is less on an average, the banks could always pursue the strategy of checking on the clients of defaults. So these will be compared to chances of default on long-term basis, long-term loans. Banks need to shift towards short-term retail loans and to take a granular approach to protect their margins under the new BASEL III norms. The next is the change in customer mix. Banks need to review their capital allocation to each client segment, and this would require an improvement in systems and procedures. This would require the refining of the rating model, data cleaning, modernization of systems and procedures may help banks economize their risk-weighted assets, which will help reduce capital requirements to some extent. How do banks assess the health of their client? There is a rating called Camel's rating system. It was developed in US that is used by the supervisory authorities to rate banks and other financial institutions. The score is kept confidential for the sake of the bank's image. It is more relevant at an economy's macro level to address issues such as systemic risk, market discipline, liquidity, and transparency in the risk management framework. It is interesting to note that though the risk capital may be necessary, safety cushion for banks, capital alone may not be sufficient to protect them from any extreme unexpected loss events. In reality, risk capital will remain only a number and may not be effective if the banks do not assess their risk periodically and take timely corrective action when the risk exceeds the threshold limit. Thus, when it is Basel II or Basel III norm, it is crucial that a bank does not depend solely on the regulatory capital. What is needed is a dynamic risk mitigation strategy where all employees act as risk managers in their own area. This requires more pooling in of resources who know more of risk management. A proper risk culture needs to be developed across the organization, especially in the banking industry, because we have been seeing this NPA problem a lot. And risk should be input for future business decision making as well. Risk management should not merely be an activity to comply with the regulatory requirements. Thank you.